Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Many companies focus on growing their revenues for years, but often don't create significant value for their shareholders. Meanwhile, some businesses with only modest revenue growth manage to deliver outstanding returns. The key difference usually lies in understanding where profits are actually made, rather than just how much is sold. This concept is central to what we call profit pool analysis. A profit pool shows how total industry profits are spread across different players, activities, customers, and stages in the value chain. Unlike simply looking at revenue, it highlights where economic value builds up and, importantly, where it may be lost. In today's world, where capital is limited and businesses face pressures like pricing competition, technological changes, and new regulations, being able to analyze profit pools is crucial for leaders like CFOs, CEOs, and boards. This approach supports important business decisions, such as simplifying portfolios, making selective acquisitions or divestments, adjusting pricing strategies, integrating operations vertically, and reallocating capital to the most profitable areas. Over the course of this presentation, I'll explain what profit pools are, why they are important, how to analyze them effectively, and how successful companies use these insights to outperform their competitors. Profit pool is the total economic profit generated within an industry or value chain, usually measured as operating profit or returns above the cost of capital. These profit pools aren't evenly spread, they change over time and don't necessarily match revenue shares. For example, an industry might have large revenues but relatively small profits, while certain segments or activities capture a much larger share of the value. Profit pools can be found across different levels, such as companies, where market leaders may earn much more than followers, activities like manufacturing or after-sales services, different types of customers, and across various geographies. Understanding where profits are concentrated helps firms ask a more important question than just whether they are growing. Are they positioned where the profits actually are? This approach shifts focus from chasing revenue growth alone to focusing on returns, helping executives spot businesses that grow but fail to earn their cost of capital. It also guides capital allocation decisions, showing CFOs where to reinvest and where to hold, leading to smarter, more strategic choices. Capital scarcity makes it crucial to know where to exit, because investing in shrinking or unattractive profit pools only destroys value, no matter how appealing the strategic story sounds. Profit pools can shift due to changes in technology, like moving from hardware to software, regulation in sectors such as utilities and financial services, or through business model innovation, like subscriptions and marketplaces. Companies that recognize these shifts early can reposition themselves ahead of competitors. Making tough portfolio decisions, especially divestments, is often challenging emotionally and politically, but profit pool analysis offers clear economic reasons that help boards make these bold moves with confidence. To apply profit pool analysis, start by defining the industry boundaries clearly, map out the entire value chain from inputs to the end customer, and consider adjacent activities where profits might be accumulating. Many companies limit their view too narrowly and miss opportunities or risks where profits are moving. Next, size the total profit pool by estimating the total industry profits, not just revenues, which sometimes means digging into public company disclosures and other detailed sources. To start, gather data from industry reports, internal benchmarks, and estimated margins from private players. Whenever possible, adjust these figures to the cost of capital to focus on economic profit, instead of just accounting profit. Next, break the overall profit pool into logical segments like customer groups, product to service lines, stages within the value chain, or geographic regions. This disaggregation is crucial because while revenues might be similar across segments, profits usually are not. Afterward, analyze the structural drivers that explain why certain segments are more profitable. Look at factors such as pricing power, switching costs, capital intensity, regulatory requirements or licenses, scale advantages, and differentiation like intellectual property. Understanding these elements helps determine whether profit pools are strong and defensible or more vulnerable. Then assess where your company stands by mapping its involvement against profit pools that are high or low, growing or declining, and defensible or contested. This process might reveal some tough realities, but also clearer strategic choices. Finally, use these insights to guide your next steps and translate the analysis into concrete actions. Profit pool analysis is essential for making informed decisions about where to invest, how to redesign offerings, and when to exit or restructure segments that dilute value. For example, in the airline industry, while commercial aviation generates huge revenues, profits have historically been low. Analysis shows that aircraft manufacturers, lessors, and loyalty program operators often capture more value than the airlines themselves. Airlines that focused on ancillary revenues like seat selection and baggage fees have moved into more profitable areas without increasing passenger numbers. In technology, profit pools once centered on hardware, but have shifted to software, services, and ecosystems. Companies that stuck to hardware saw margins shrink, while those embracing platforms and subscription models captured more stable, recurring profits. Financial services provide another insight. Banks found profits concentrated in fee-based services, wealth and asset management, and specialized lending, leading many to divest capital-heavy units and focus on advisory and wealth platforms. Lastly, industrial conglomerates often find that a small number of their business units generate the majority of economic profit, prompting portfolio simplification efforts. These examples highlight how understanding profit pools guides smarter strategic choices to enhance value. Some parts of the industry absorb capital without giving much return because of factors like scale, regulation, or how cyclical the business is. Profit pool analysis has helped many companies get back to the basics by simplifying their portfolios and focusing on where real value is created. One big advantage is that it reveals the economic truth, cutting through stories and forcing leaders to see where the money actually comes from. It also gives clear guidance for strategy decisions, mergers or acquisitions, and when to divest parts of the business. By identifying where profits are strongest, companies can use their capital more efficiently, putting money into opportunities that offer lasting benefits rather than chasing volume growth that might fade. However, there are some risks too. Profit data can be tough to find, especially in fragmented or private markets, and profit pools change over time, so relying only on a one-time snapshot can mislead. There's often resistance inside companies because challenging established profit pools can threaten existing businesses, leadership positions, and incentives. Lastly, it's important to remember that not all value shows up immediately. Early investments might look weak at first, but could become very valuable later. The image here with puzzle pieces fitting together highlights how all these aspects need to align to understand the full picture of profit pools. Modern CFOs actively integrate profit pool analysis into key decision-making processes like portfolio reviews, investment committees, M&A screening, long-term planning, and crafting investor narratives. This approach complements traditional financial metrics such as ROIC, free cash flow, and TSR decomposition, creating a comprehensive toolkit for driving value. Profit pools shift the focus from simply selling the most to strategically positioning where economic profit is most concentrated and sustainable. In this time of heightened capital discipline and strategic evaluation, profit pool analysis has become more than just a tool, it's a critical leadership skill. For CFOs and boards, understanding profit pools helps uncover the deeper drivers behind returns, enabling smarter decisions, better allocation of capital, and more durable strategies. When used effectively, it drives growth that truly adds value, but if ignored or misapplied, it can result in companies growing busier without becoming more profitable. Ultimately, it challenges leaders to ask whether they are competing in the right areas to win, not just to grow. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.